$12.1 billion. I mean, wow. It's a massive, record-breaking number. But more importantly, it's hard proof. What we're looking at today isn't just your typical tech hype story, it is the reality of signed, sealed, and delivered contracts. Welcome to The Explainer. Today, we're diving deep into an unexpected hero operating right at the absolute center of the AI infrastructure boom, Trane Technologies. Now, you might know the name from traditional air conditioning, but as we're going to see through the data today, they've evolved into an absolute giant in the high-stakes world of AI thermal management. Here's our roadmap for this explainer. First, the AI HVAC boom, followed by their record-breaking second quarter. Then we'll cover cooling the AI revolution, green growth, and leadership, and finally, we'll weigh the bull and bear case. Let's jump right in. Section 1. The AI HVAC boom. More than just air conditioning. All right, let's look at who they are right now. Trane Technologies operates primarily through two strategic brands, Trane for building and industrial climate solutions, and Thermo King for transport refrigeration. Since launching as a pure-play climate innovation company back in 2020, they have nearly doubled their annual revenue. Why? Well, because they're uniquely positioned at the perfect intersection of three powerful global megatrends: the energy transition, advancements in climate innovation, and of course, the rapid acceleration of artificial intelligence. Section 2. Record-breaking second quarter. A blowout performance. The actual numbers here tell a completely undeniable story. Wall Street analysts estimated $6.21 billion in revenue, but Trane actually delivered $6.35 billion. That's an increase of 10.6% year over year. And on the bottom line, their adjusted earnings per share came in at $4.31. That was up 11.1% from the prior year, comfortably topping the consensus estimates. Basically, they just completely outperformed Wall Street across the board. And this brilliantly illustrates exactly where the market is really paying attention. Total organic bookings surged by an incredible 37% in the quarter. But when you look a little closer at the Americas commercial HVAC division, that grew by 50%. And then there's the absolute standout, applied equipment, up 130%. That marks the fourth consecutive quarter of triple-digit growth in that specific segment alone. The velocity of these incoming orders is just staggering. But you know what's really interesting? This single number right here, 123%. This is Trane's enterprise book-to-bill ratio. What that means in simple terms is that for every single dollar they bill, they're booking $1.23 in new orders. In fact, every single operating segment across their entire portfolio posted a ratio above 100%. They are literally pulling in new orders faster than they can bill for them. Which brings us full circle to that massive hook we started with. This breaks down that record $12.1 billion backlog. What you really need to take away from this is the incredible revenue visibility it provides. Roughly $6.1 billion is near-term, but CEO Dave Regnery noted that approximately $6.0 billion of this backlog is scheduled for 2027 and beyond. So this isn't some short-term flash in the pan. This is a multi-year, highly visible runway of secured growth. Section 3. Cooling the AI revolution. The data center catalyst. So as we all know, AI data centers generate massive amounts of heat, and they require highly specific thermal management. Trane tracks 14 verticals in the Americas, and while literally all of them posted over 20% booking growth in Q2, data centers are the undeniable star of the show. Just look at this rapid-fire strategic expansion. In March 2026, they acquired LiquidStack to dominate liquid cooling. By mid-2026, they integrated Stellar Energy, that's a modular chiller plant provider expected to bring in $500 million in revenue just from its own backlog this year. And then, in August 2026, they launched a massive collaboration with Eaton and NVIDIA. And these rapid moves, they are already paying off big time. When talking about the LiquidStack acquisition, CEO Dave Regnery stated that the liquid cooling technology is exceeding expectations and that the pipeline is exceptionally strong. They didn't just buy a company here, they bought immediate success in a vital AI sector. Let's see how this builds into their most recent strategic play announced on August 17th. Trane collaborated with Eaton to create an industry-first reference design specifically for the NVIDIA DSX AI factory. And look at these transformative metrics. This integrated system promises to boost energy efficiency by up to 15%, reduce installation costs by up to 30%, and incredibly, cut copper use by up to 80%. This rate here shows exactly why Trane is absolutely central to the physical build-out of our AI infrastructure. Section 4. Green Growth and Leadership.
sustainability as a business model.
To manage this crazy rapid scale, the company actually made a key executive move. On July 1st, 2026, Donnie Simmons stepped in as Chief Operating Officer. Simmons is a 25-year company veteran who previously served as Group President of the Americas. And this appointment? It's a clear move to align their operational leadership directly with their drastically expanding market opportunities.
So, the crucial point to understand is that alongside managing scale, sustainability is deeply embedded as a core business model here. It's not just corporate greenwashing. Look at their recent 2025 sustainability report highlights: 331 million metric tons of customer CO2 reduced since 2019, a 59% drop in their own operational emissions, and 84% of their global electricity is now met with renewables. Most importantly for future growth, they invested $348 million in R&D last year and introduced 110 new decarbonization products. They are literally profiting by helping their customers meet vital energy efficiency mandates.
Section 5. The Bull and Bear Case. Valuation and a reality check. Let's start with the bull side and the analyst outlook for 2026. The company recently raised its full-year guidance to about 11.5% revenue growth and an adjusted EPS between $15.20 and $15.30. Analysts are incredibly positive on this. Out of 24 analysts polled by S&P Global, the consensus is a buy, with an average price target of $525.28. Analysts like Varun Govindaraj from Bernstein even raised their target to $575, specifically citing Trane's exceptional multi-year visibility. But let's have a real valuation showdown. The bull case rests on unprecedented structural AI demand and that massive $12.1 billion backlog providing rock-solid revenue visibility through 2027. However, the bear case points firmly at the price tag. Trane trades at a steep 27.24 times forward earnings. That's well above the industry average of 21.22, and it's higher than their own 5-year median. The bear argument is simple. At this price, perfection is already priced in, leaving absolutely zero margin for any execution errors.
And there are very real risks that could disrupt that perfection. Let's review the grounded reality. First, margin pressure is a real thing. Adjusted operating margins actually declined 60 basis points, or 0.6%, down to 19.7% in Q2, mainly because inflation and heavy investments outweighed their volume growth. Geopolitically, the Middle East conflict is expected to cost their Europe, Middle East, and Africa segment roughly $100 million in second-half revenue. On top of that, Thermo King, their transport refrigeration side, is a bit of a drag, declining by low double digits in Q2. Lastly, Trane has expanded applied capacity fourfold in just 3 years, and scaling that fast, it always carries inherent execution risk.
Which leaves us with the ultimate question as we wrap up today's explainer. Is the AI growth and that spectacular $12.1 billion backlog durable enough to justify the premium valuation? Trane is executing brilliantly and aggressively capturing the AI data center opportunity, for sure, but you are definitely paying a premium to join the ride. As always, you've got to weigh these risks against the growth potential and consult a qualified financial advisor before making moves. So, what's your take? Thank you so much for learning with us today.